All right. Good evening, guys. Ken at Tortoise Capital with the strategy podcast for Friday night for October 23rd, 2020. Just going to do a quick debrief of the day, and then we'll be taking a look at the weekend report and in order to set up your preparation work to be reviewed for the Sunday night podcast. For the hybrid trading folks, there will be a Q&A session and coffee talk in the morning at 10. And then I plan to do some form of teaching session at 8 o'clock tomorrow night. Just I'm kind of in the mood and I want to get things done. So not sure what the topic will be yet, but it'll be something. All right. So yesterday we saw how this selling pressure kind of ended the upward trend to the point where the PSAR, which got this high, ended up reversing yesterday to here when the RL10 basically crossed through the PSAR trail of tears there. When the RL10 crosses, that's when the PSAR flips. And now what we have is the beginning of this downward pressure. And so for that downward pressure, which is this, this arrow here, for this to reverse and go to the upside, we're going to need to see price come up and reject this, and then the RL10 here ends up having to roll up and then get through this declining PSAR. So we'll see the PSAR start to slope down as an upward pressure, and that's going to put pressure on this thing that if you're going to go down, you're going to have to stay below that PSAR. And you notice how this thing curls and kind of accelerates. That's the way this cascading PSAR kind of fails like that, right? So we will keep an eye on that, and until price followed by the RL10 gets through that, then this is the primary trend is down right now, and that's reinforced by kata number 2, which takes a look at the RL10 peak here, and then the next RL10 peak, and the fact that that is a lower high now gives us the 1, 2, 3 pattern of kata number 1. So here's the, here is a high. Let's make that bigger so we can see. So there's the 1 at the peak of the RL10. Here's the bottom of that RL10. There's 2. And so this peak here is 3. Now says this could actually be a short right in here on that RLXD and the break of the PSAR. So this could be short. And then if you're short in there, excuse me, the indicated stop would be the RL10 PSAR. That would be the limit. That's the price that invalidates the downward pressure, right? And so that would stay in place until such time as, if you treated the entry at the RLXD, and said, well, I'm going to get short like right here, then what we would need to see is the PSAR dots. Let me draw some of those here real quick. As this PSAR starts, imagine that price were continuing to fail. We would need to see 1, 2, 3 PSAR dots below the entry. And then at that point, let's say if it happened out here, then this initial risk here would then come down, and then that would be the Wu Wei exit. So on a daily basis, that's what kata number 2 looks like on the short side, right? So we'll be monitoring that. Now, if this is the right here at 4, this is the pocket entry. Inside this space here is the pocket. Where you get the collapsing dragon would be down here at 5 or at 6, right? So let me draw those in for you so you can see the pattern for swing trading. You would either have an entry, you could say the collapsing dragon here at 5 when it breaks the belly of the dragon, or if you waited for the belly of the RL10 at 6, all of those would be, that would be a pure collapsing dragon at 5 or 6. So if we're looking at entering in the pocket and trying to front run those, then what you have is any short positions like in this yellow box in here, much like this entry at 4. Any entry here in this yellow box on the short side is a pocket entry, right? So you could imagine how a violation of the Bollinger Band mean or the Z1 could also be additional entry points, or those would be key price levels that if you're looking to do this turbo in intraday, then those price levels there would confirm to you that on the daily chart that the weakness is continuing. And then if you're trading intraday, then those become price levels where you can add. So you could imagine how if we had some selling pressure on Monday, say it opened here and then started failing down, a break of the 10-day low, well, that would tell you that this thing is really collapsing. So that'd be a way to add. And then if it went down through the Bollinger Band mean, now that has negated all of this upward price action, right? All that would be then erased. And then you're looking for more movement to the downside. Then if this happened and the Z1 were to break, then you could add another position. And then if the belly of the dragon broke, that's adding a position. And then if the RL10 broke, that's adding a position. So could this happen? Yeah, that could happen because this happened on the upside, and it's harder to believe in the upside than the downside. So if that's what the upward move looks like, this could certainly happen on the downside. And then that gives you a really symmetrical price action. And in fact, that price action looks exactly like this price action. So could that happen in 4 days? It absolutely could. It already has. What makes it interesting, though, is that here you actually had a sell-off, a recovery, and then a sell-off. So you have the second leg. So this could be the first leg. This could be the second leg up, or the rebound, and then that could be the second leg down. So that's sort of the potential inside of this formation that we're looking at, right? So that makes this this resistance level here at the dragon so important, because if this acts as resistance, now this downward move becomes a lot more interesting. In the same way that when this was moving down, the dragon was acting as resistance to the upward move, and it wasn't until it broke through here and got into this area on the far side of the dragon, that RLXD, that you get this move. Well, that's exactly what we have here, is that we have price action on the southern side of the dragon, and it is still acting as resistance, and the dragon is rolling over. So that's what the downward pattern looks like. And then the upward pattern would look something like this. Well, no, that's, if for some reason the market likes that, it has to get through the hump of the dragon and then through this resistance at this descending PSAR and the hump of the RL10, And then it has to really get above the 10-day high, 30-day high to be really persuasive. Then that would be persuasive because that takes out this previous resistance level at 3. And then if it gets above this hump of the dragon here, yeah, that's really where this thing takes off and gets going strong. So there's some serious resistance overhead. And that resistance is what happened at 3, which gave us this first leg back. And now the question is being put to it here at 4. What's it going to do? Is it going to grind up, or is it going to fail down? If it fails down, it looks like this. So that's what the on the daily chart, the trade frame looks like to me. Okay. Let me know in the comments if you found that to be helpful. Because I do like to be helpful. All right, so here's the S&P at 0.34, and let's walk our way through the table in the usual way. So the S&P was up 0.34 today, and the Russell was up 0.58. The Dow was down a fraction at minus 0.11. Yeah, I'm looking for my treasuries here. Oh, there we go. And treasuries made their little rebound today at 0.61. So the defensive play of the treasuries and the speculative play of the small caps both outdid the large caps in the market, where the super large caps suffered the most down here at a fractional loss or basically flat. So that's kind of a mind split in the market. It's really given a mixed signal. The speculators are speculating, the defensive players are defending, and only the Dow 30 really underperformed. So that is a non-directional, non-committal market for sure. So there's nobody wanted to have too much of a position going into the weekend, is how I interpret that. All right, so let's look at the sectors that were better than the S&P. So we have 3 of them right here, slightly better. Materials, healthcare, and clean energy. You have emerging markets at 0.59. You got Mexico and Bill Ackman and the FANGs, and commercial property and consumer discretion all between 0.85 or 0.75 and 0.85. And then the symbols that really worked well. Starting from the top, look at how well the metals performed. So you got U.S. Steel at 6%, Cliff Natural Resources, a steel company, 4.8. Then you got some tech leaders, NVIDIA, Google, and Amazon, coming in at 1.7 to 0.8. That's why the FANGs did really well. And among the FANGs, those are the ones that really dominated. Then you got Procter, Home Depot, and Microsoft, the kind of the bellwethers in there. Procter just continues to do really well. And then the techs, or triple techs. There's TQQQ at 0.58. And where is our... And yet TECL, that's the broad tech sector, was down 0.58. So the NASDAQ techs did really good. It's unusual to see that kind of a split among the techs. That was, part of the mind split that happened today, the fragmentation, all just kind of tactical backing and filling, no directionality. All right, so let's see what underperformed the S&P. So the S&P is at 0.34. So there is oil exploration, equal with the market. Finance, slightly less, a little bit of volatility. And Japan, silver minus, his first one in the red at minus 0.09. There's your tech at minus 0.11. Not much damage there. Energy down 0.5%. Brazil minus 1%, minus 1.2, I should say. Then you got oil minus 2. And now some problem, the problem companies, the big underperformers. Intel, which has been struggling so hard to recover, then gave back 10.5% today. Virgin Galactic 7.6. Alcoa kind of splitting away from the other metals. We saw Cliff and Nucor and U.S. Steel do well, but here's Alcoa suffering. Tesla was a lot worse in the morning. It was down around like 405. It was down almost 4%, 5%, and it came back to only be down 1.2. So still very volatile. And Musk is in the news talking Mars again, but solid. As long as that's above 400, then it's free and clear. Boeing and Nikola Cat. Now here's some other tech losers. There's Apple in there. So I would say Apple, Tesla, and Virgin Galactic and Intel. That's the weakness in tech there. Yeah. Okay. That's all I want to say about today. It was really just kind of a tactical intraday opportunities. The usual suspects were moving. I want to shift real quick since it's getting late already to the weekend report. Let's get through that so you have something to start working on tomorrow. So we are looking at still bullish normal, and we actually got a little bit of recovery after the sell-offs earlier this week. The 3-day is back to 64. Nice little rebound in there. Still suffering in the risk Z, warning us about the downside of volatility as the election creeps ever closer. The lack of trendiness now has become officially weak, and so anytime it goes below 15, we want to be on our best behavior, ready to see what the next new leadership is going to be, up or down. That's what the ADX indicator, when it goes below 15, tells us. The volatility actually got weaker today. It's back down to under 1.5%. The holdings are still holding, in the blended monthly rebalancing, with the next reevaluation getting closer around 1 November. The leaders in the clubhouse, small caps, tech, and mid caps. In ETF 32, it's clean energy still doing well. Consumer discretionary and tech. ETF 2, the theoretical exposures at 100%, meaning all 10 of the big global indexes are above their 4-month moving average. So there is some broad goodness out there. In the monthly health check, the sell-off is recovering here. It's still right in the middle of the last month and just crossed over Z2 at 340, 345. So that's, as long as it's above that Z2, then that's as good as it can be. Uh, if you're long on this one, I think the monthly low at 330's got to be your protected. That's a 5% cushion. I couldn't imagine giving back more than that. There's no reason to do that. We've really got to see it. We don't know anything new until it gets above 360, though. So this is what that yellow zone looks like to me. There we go. I knew Adobe would let me do that. I think that's what the yellow zone looks like right there. On the monthly charts, anyway. To me, that's what I would just say the dragon is the yellow zone right in there. And as long as it's above that, that's about 335. So that 330 to 360 is what that monthly yellow zone looked like. And we're in the upper half of that on the weekly. A break below 330, I think, is auto short. Then that would be short all the way down. I'm not really sure between that, the bottom of the weekly zone here at about 345. I suppose you could go that far, or you might, if you were more aggressive, you could start getting short inside there. I think that's a matter of. I think I would wait to see. Maybe the PSAR, the PSAR break, I think would be decisive, and then certainly 330 because that's a nice important round number that we get from the monthly. So I think I would take it maybe I would just bring this down to here. Yeah, I think that's the way I look at it. I would get short at the PSAR break. Yeah, that looks correct. Then I can't imagine getting new positions in until it gets above at least the weekly high. You might even want this second weekly high here. Yeah, I can't see doing that before the election. So purely tactical to the upside, but I would be ready to get short if it broke below that 330. Looks like 335. Yeah. We've already seen the daily. All right, so what worked? So Latin America had a tactical payoff. Treasuries just still struggling, although they closed well today. The ETF2 tells, and the BMR tells us it's those three. Nothing wrong with that. They all had 3 pretty good weeks. Emerging markets are actually starting to show some strength in there. ETF 22 just adds energy to the misery index. And then you can see the 3 sectors that are at the top of the stack now. And consumer discretionary looks to be the best of those 3. That's the second week in a row we've seen pretty good performance out of the industrials, better than their counterpart in materials. A small advantage to XLI. XOP and XLE both rebounded pretty nicely, but that's kind of a tactical trade to me, the rebound from misery. They're both very liquid, and they can be traded intraday with good effect. And wheat and precious metals has really just fallen off the pace. Dow 30. Apple is suffering. It's below its 4-month moving average, but I attribute that to just how powerful this move has been. But I'm still ready to add positions to them. I was reflecting on companies that over the years that I have just really not liked them on a personal basis because of their leadership or their policies or as companies or what they do. And the three that really come to mind for me were General Motors, my background in the automotive industry. I just hated them and the way they couldn't see the writing on the wall. But I was able to overcome that and trade them from 20 to about 40 after they had some troubles and then rebounded nicely. So I was able to overcome my disgust for them. And then Microsoft and Apple were both companies that I had disgust for. Microsoft, I was mad at them because they bought Lotus and then killed all the good Lotus programs that I loved working with. And I still can't forgive them for that. But I've been able to trade them. And Apple, I've just always despised Steve Jobs and all the things that they stand for, the consumerism and the fanboys. But I've been able to trade them lately, and now that my hatred for them has shifted to like Facebook, because I despise Zuckerberg and what he stands for. But I'm becoming a little more sanguine. It's easier for me to trade those now, and I've been able to separate my disgust for their leaders with the characteristics of the stock. And so, fortunately, I learned that in time to be able to trade Teslas. So, Apple, I just don't have any negative feelings about them anymore. I'm sort of immune to them. And so now I look to them as an opportunity trade, only because that's the way conservative pension funds can play tech with a company that's basically a consumer provider of consumer goods. It's almost not even a tech company anymore. Shouldn't we be thinking of Apple as a consumer discretionary or maybe even a consumer staple? That's a reframing. I mean, because it doesn't feel like they are technology geniuses anymore. That's sort of been gifted over to, Tesla, Twitter, Google, Facebook. But Apple's just kind of a consumer. I think it's a consumer staple, and more like an entertainment stock than anything else. And my hatred of Microsoft ended when Ballmer left, and now they're just they really are reinventing themselves and becoming pretty good corporate citizens and getting things done, and have made a pretty good run this past couple of years. Boeing just is being blown around the wind by the wind of congressional bailouts. So there's no business model there that looks any good. It's only their defense. It's only their capacity to be a defense industry company that you have to preserve the only airplane maker which keeps them in business. And then these two have been quietly getting it done as well. United Health and Travelers, just quietly, and so has Procter and Home Depot. Both things to watch. Honeywell, a new addition to the Dow last month, is just a great tech company that knows how to take care of its business niches properly. I studied them a lot in the doctoral program, so I just like them. That's just one to keep your eye on. Great company. And Caterpillar going to rebuild American infrastructure right there. This has got to be anytime you see that, you got to start believing that NVIDIA has just won the chip wars. I mean, man, how can our chip company be that bad? In the sectors, regional banks on the up and regular banks on the way up. And both of those aspects of the financial system are outperforming the broad financials of XLF. So that looks like something for us to pay attention to here. Looking for more follow through. And then I just think on the other hand, the oil and gas is just simply a tactical rebound from just horrible performance. There's nothing fundamentally great about that. That just looks like a tactical rebound. And probably sovereign wealth funds propping up energy sectors to support national industries. Look how bad Intel is compared against the semiconductors, but man, wow, that's just brutal. U.S. all above average. South Korea, India, Philippines doing pretty well. Treasuries and bonds getting smoked. Silver is still in the green, but it has come way off its high. It's consumer discretionary, getting it done. And the industrials are just also, like on the strength of Caterpillar, that kind of company is getting it done. And energy is just as bad as it can be, bouncing off the bottom like an empty can. The growth index inside the Russell is maybe where that strength in IWM, whereas XLK Tech has given it up. And again, I like the way the industrials have been responding. They are quietly climbing the ladder. So XLI is one for us to continue to watch. So XLI is white and white. That's consistently good. Monitor, follow the trend, watch for new interest. Can be traded intraday. It's easy to believe how that thing, if it just continues to outperform, could end up getting into the green here someday soon. We'll shift to the daily. Lots of dojis today. No conviction or follow through. Plenty of auto framers to choose from. JP Morgan had the big breakout today in the NDX, whereas Intel just got slaughtered, and American Express was a weaker member of the banking side there. So that could be a specific problem with AXP. Lots of dojis in the ETFs. We'll let that come up on your screen. Plenty of auto framers. The retest of the 10-day high. Here's Mexico, had a nice big breakout today, as did the Russell, and as did utilities. These two, Mexico and mid caps, are the ones that I'm really interested in. Auto framer, tons to choose from. There should be a lot of good work this weekend on these swing trades and being postured for success. That's all I'll say on that. And the daily squeezes, these are the ones that had small ranges today but are postured for big moves. So there's Tech and Procter and Apple and Microsoft in that stack. And even the S&P itself is in there. So that tells you how non-committal today was, and people had gotten out of their positions or just waiting to get after it again next week. The pullback in the fall was not very surprising. So maybe some follow through as Brazil and Latin America recover. That could be the case. I like Caterpillar in the summer here, along with McDonald's, and Travelers has been the best performer by far. Let's see if there's some follow through there. And then Intel just smoked. Easy to believe that that's got more weakness in it too. Intel and AXP on the NDX, no surprise. Minus 330 on the 3-day. Oof. Brutal. United Health and Travelers, and Walgreens, I should say. Merck and Disney on the 3-day breakout. And here's your two biggies, mid caps in Brazil. Mid caps in Mexico. And a quiet case being made for EPP and emerging markets. So some of those smaller countries are just kind of quietly creeping their way north as the U.S. begins its big transition. Maybe that's offloading some opportunities in that area. So meanwhile, we're just going to continue to be playing the role of the master opportunist. Shorter term trading, grabbing them while we can, putting it away for the winter. That's the ticket. And that's everything I want to cover for tonight. We'll get this published and posted. Q&A session and coffee talk in the morning. Maybe a systems thinking workshop tomorrow evening, and then looking at the charts that you guys post on Sunday night in the usual way. Okay? Take good care. Thanks for hanging in there tonight on a late one. And we will see you tomorrow or in the chat.